global bond yields ascend as hawkish-sounding Fed minutes add to concern that rates will stay higher for longer. The U.S. benchmark 10-year yield sits near 2008 highs. UK gilts are jumping to a 15-year high. German bond yields are also rising. All of these moves suggesting investors are putting another Fed hike firmly on the table. The question now is it going to be September or November? Probably less important than maybe what even happens next year. Matt Luzzetti is with us now to walk us through all of this. Deutsche Bank Securities chief U.S. economist. Matt, I don't know that it matters a whole lot whether it's September or November or when or the next one's happening. People are like, forget about that. We're looking to next year already. And we're looking to cuts already. Is it too premature to look for cuts next year?
Yeah, so I think the big reassessment that we've seen in the bond market has been two things. One, maybe a little bit more in terms of rate cuts near term, but the bigger story is pricing out rate cuts from next year. For a long time, the market was pricing these steep cuts next year on the worries about recession. A lot of those rate cuts are coming out, and that's a big driver. The second is a steepening of the curve, some building back of term premia. Now, that has come on the back of a few different items. Federal deficits have been higher. Treasury issuance has been higher. The Bank of Japan backed off of yield curve control. And so we've seen the longer end of the curve rise pretty substantially. So you have those two things that are going on at the same time, both leading to higher yields.
But is it realistic that we could see the Fed cut rates prior to them hitting their inflation 2% target that they've continued to really pound the pavement about?
Yeah, so there's a few different avenues that you can get there for rate cuts, even with inflation still above their target. One would be that you get a recession. That's been our baseline. That would very clearly lead to cuts next year.
But is that still the most likely that we see a recession?
For our baseline, it is, and it'd be more substantial than what the market is pricing. There's an alternative route to rate cuts, and that's the one that the Fed has been talking about most significantly. And that's that as inflation comes down, they basically cut rates so that their policy doesn't become too restrictive or too tight over time. And so they forecast 100 basis points of rate cuts next year purely on that type of story.
I guess what I'm trying to figure out as we continue to see yields climb is at what level that does finally start to become restrictive and constrictive for growth, because we haven't seemed to have gotten there. Like, when does that long and variable lag arrive?
It's a huge question. I think what we saw from the Fed minutes this week is they're struggling with that understanding exactly those lags. Typically, you think of it about 18 to 24 months, but we had this substantial front loading of tightening. We saw mortgage rates spike. We saw the housing market, collapse in terms of activity up front. And then there's a real question of, if yields don't move substantially higher for here, why should we expect growth to slow down? And I think that's what the question that everybody's grappling with. I think where we are probably seeing it so far, maybe on the global side of things, you're seeing some stresses occur within China, in some emerging markets. I don't think that has direct economic effects or big direct economic effects on the U.S. macroeconomic outlook. Where I think it might have effects is through financial markets. And so we've seen, modest risk aversion over the past several weeks. The spike in yields, I think, driving some of that, and some worries out of China driving some of that.
I'm not certain how many Fed meeting minutes that I've looked back through where there's been a mention of the volatility in the S&P 500. And I bring that up to the point in the question of, is this a Fed that's paying close attention to the markets? To what extent are the markets perhaps driving the Fed, too?
Yeah, I think they will always say they're not just focused on equities, and that they view financial conditions broadly. And when Chair Powell talks about financial conditions, the number one thing he always mentions is real rates. And so I think that they would be encouraged in some ways that we're seeing 10-year real yields at highs post-pandemic, that you're seeing shorter end real yields moving higher, that you're seeing some pricing out of those rate cuts. I think the Fed will be encouraged by that. At the same time, they're seeing data, the retail sales report this week, which was very robust. They're seeing a consumer that's not slowing down. And the minutes this week made it clear, as Chair Powell did last month, that they need to see growth slow in order to have confidence on inflation. And so, yes, real yields are high, but they probably wouldn't mind seeing equity markets a bit lower, credit spreads wider, broader financial conditions tightening.
I'm glad you mentioned the retail sales report, because I was going to ask you about that, because it was pretty remarkable to see that number. And I was reading a note from Krishna Guha over at Evercore ISI this morning, where he talked about the conundrum now on the part of the Fed, where inflation is coming down, or the rate of inflation is coming down, but growth is not. If it is just inflation, you just said that they want to see growth come down. What if it doesn't? What if you do continue to see disinflation, but you don't see growth slow?
I think it's all a question of magnitude. If we were to get all the way back to 2% without seeing growth slow and the labor market loosen, a fantastic outcome from the Fed's perspective.
Is that even possible?
We think it's unlikely. And the Fed, thinking about risk management, in the minutes this week, they talked that most officials still see substantial or significant upside risk to inflation. And a big part of that was the growth story and the labor market story. So I think they will think it's unlikely that you can get robust growth, a labor market with a 3.5% unemployment rate, pretty elevated wage growth, and inflation all the way back down to 2%. I think an environment which we could have is that you get inflation down to 3% relatively easily, based on the fact that supply side is being resolved and you're seeing some other pressures come off. Shelter inflation is going to decline. But getting from 3 down to 2% might be a more difficult environment without growth slowing.
Interesting. Great perspective and insight as always. Matthew Luzzetti, Deutsche Bank Securities Chief U.S. Economist. Hope your summer's going great. Thanks for joining us.
Thanks so much.
Have you tried pickleball yet, by the way?
I played pickleball in high school, actually.
Wow.
So a long time ago.
I didn't even know it had been around that long.
Deep value right there.
High school gym class.
Oh, how
But
funny.
have not played since then.
Wow.
Okay, mind blown. All right, I guess we got to go to commercial break now. What do we do with that? My goodness. Thanks so much, Matt.
Thank you.